All major markets made positive ground over March, despite the war in Ukraine, a rebound in oil prices, the Fed's current outlook on interest rates, and a continuing rise in bond yields. These issues have been offset by mostly solid economic data and rising earnings expectations, and the hope that equities will be a hedge against the threat of higher inflation. Starting with growth assets, through March the market rebound has continued, but the risks around the conflict in Eastern Europe remain high. There is intense economic pressure from the sanctions facing Russia, and this may force both sides to accept a peace deal, which will be good in the short term for global equity markets. So in response, the market is reflecting some of the risk of this, and we're starting to see an increase in both oil and gas prices. So overall, Ukraine-related risks for investment markets remain high, at least in the short term. So moving to the US, the Federal Reserve is getting even more hawkish, which means the expectation of interest rates will be higher. This of course pushes bond yields higher and prices lower. In the UK, we also saw another stronger than expected acceleration in inflation in February to 6.2%. So now the challenge of central banks is that they're battling both shock increases to prices, but also longer term inflation expectations. And the consequence of this is a situation where we start to see a spiralling effect in terms of price and also wage inflation. So in terms of factor performance in growth assets, momentum, then growth and quality performed the best over March. Turning to defensive assets, well, unsurprisingly, major bond indices fell, with yields in the short end of the yield curve rising and the longer end remaining broadly the same, as the pace of interest rate rises are expected to be temporary. In summary, as we move towards the end of the tax year, based on historic data, this tends to be a more positive period for equity markets. Whether we see that this time remains to be seen due to the current ongoing geopolitical pressures the market faces.